You're all very welcome to this interesting panel session on the challenges and opportunities in private equity. To give this session some sort of structure, we thought we would go through the P life cycle, so starting at fundraising through to pipeline and origination, issues around asset management, and then liquidity and exit at the end. So it's a tough environment, clearly, for fundraising at the moment with the macro situation, denominator effect. But obviously there are some chances for GPs to differentiate significantly. And we've seen some changes in terms or other developments which may be sort of positive on the LP side. If I could start with you, Rebecca, on your experience on the fundraising side.
Thank you. And Amy, you're right. It's been a sort of period where you had, a very difficult environment in the last few years. When you look at the record levels of fundraising a couple of years ago, that pulled forward a lot of the capital commitments for the LPs. And they're now faced with an environment with over $1 trillion of uninvested capital waiting to be drawn, and yet now a massive slowdown in distributions, where we're now down at levels not seen since the GFC. So they're sitting there with a challenging outlook. It's very difficult to have visibility on those distributions going forward. So that's why I think there's a lot of concern about that wider fundraising landscape. At Oakley, we've benefited from a few different trends and actually successfully closed a fund after just 4 months in the market for our lower mid-market strategy, Origin. And we were fortunate because we played to, I think, a number of characteristics that highlight where I think there still is optimism in the fundraising market. LPs are very discriminating and looking for funds that are very clearly focused on their investment strategy, so recognizing where funds have continued to do that and have a track record. Returns are very important, being able to show realized track record, but most fundamentally, I think distributions. That's become a real differentiator in the market at the moment. And at Oakley, we were able to return 1.7 billion euros last year. When you think that I think 80% of distributions are used to fund re-ups, that gives you a real momentum. And what we found that was interesting was actually that was for existing investors where we had very good support. But once you had that momentum in fundraising, new investors would quickly follow because they are keen to keep putting capital to work, but often worried that they may be investing in a fund that's going to take several years to actually close, which can be very disruptive to the team and impact their ability to source deals. So having had that early momentum, we're able to then bring on a number of new investors who were attracted by that quick close.
Interesting, thank you. Lucia, can I bring you in on your experience?
Yeah, of course. So we're not currently fundraising, but we are definitely keeping our ear to the ground, trying to make sure we understand dynamics so that when we do come to market, we can put our best foot forward. And what we are observing is that there is no denying it's a tougher fundraising environment than it's been for a long time. But the data seems to suggest it's not getting tougher, which is good. So hopefully we're sort of starting to turn a corner. And we actually think that there's quite a lot of opportunity in the mid-market where we sit, despite this reported squeeze from the flight to capital to the mega funds. And I guess the reason why I say that is because I'm yet to meet an LP that wants to allocate the full private equity portfolio to mega funds. I think most LPs understand that actually backing the right mid-market managers can provide a good opportunity for outsized returns and can be a good complement alongside some mega fund exposure in the portfolio. I guess the question is, what is the right mid-market manager? What LPs tell us is that they're really looking for specialists who are leaders in their specialized strategy and who've got a developed track record and an established team in that strategy. So I think if you're able to demonstrate confidently that differentiation, as the Oakley case study shows, maybe fundraising is not looking quite as gloomy as you might have thought.
Okay. Well, let's hear from the LP side then. Matthias, what's your view?
Thank you. And I guess I first take note of the fact that I'm the only LP on this panel. So I guess it's the opposite of the fox in the hen house. But
we'll all be talking to you soon.
Yeah. You already have been. So I think, the comments I would echo, it is a tougher fundraising environment with capital flowing out of the market in general. And what we're seeing is funds are getting to a decent sized first closing of, say, half their target or even up to 70%. And then it takes them up to a year or even longer to get to the final target. But really, that's more of a reversion to what was the norm before. We've been in a sort of extraordinary period where funds kept growing in size, and they also kept raising money more quickly. And that wasn't the normal. So really, we're just reverting to what was a normal fundraising cycle. And I think for managers, it's really about preparing ahead of time and preparing your LPs for the timing of when you're going to come back, and also making sure you have strong support from your existing LP base. So I think the bifurcation we're seeing has a lot to do with the LPs you have in your fund and their availability of capital and their ability to support you in that first closing.
Okay, thank you. So if we move on then to sort of pipeline and origination, as an M&A lawyer, we've certainly seen deal flow slow. Deals are taking longer to do and a bit more difficult to execute. Be interested to understand what you're seeing in terms of challenges or indeed opportunities in the current cycle. And maybe I'll start with Lucia this time.
Yes, so I guess it's hard not to get depressed with the constant flow of bad news coming out of the UK. But we see more opportunities than challenges, actually. So our investment strategy is somewhat counter-cyclical in that we are BCAs when there's a bit of disruption in the M&A market, when debt maybe is not as readily available, and also when businesses in the UK are facing some headwinds. It's definitely a time where we also benefit from the fact that we don't really use third-party leverage, so we fund our transactions all ourselves. So that is helping, giving us an edge as well, because we can deliver with more certainty and more speed. And sometimes in those sort of complex situations, that can be more important than price. So I think in summary, yes, it is tough out there, but I think if you've got the right strategy and you've got the discipline to stick to it, I think the next 2-3 years are going to be great vintages.
Okay, Rebecca?
Yeah, I think I'd echo a lot of that. I think what you've seen is the withdrawal of many of the large kind of auctions, which were led with a stapled financing, underwritten by banks, and running a very tight process. Unless you've got a fantastic technology asset, that's probably not going to be happening today. At Oakley, our strategy is very much about backing founders, so 80% of the time, we're working with someone who's never had institutional capital before. And for them at the moment, they're facing many of the same headwinds that we're looking at. So rising interest rates, supply chain, inflation. And so for them, actually, now in this environment where they may be more attracted to working with an institutional fund that they can feel can de-risk them and help them scale up and continue to grow. They may have gone to a debt solution before, and that may not be available anymore. So again, when you've got a clear strategy, both in terms of sourcing, and if you can demonstrate that you're going to really provide value to your company that you're working alongside, then I think it's still very possible to do deals. What I would say is we've noticed they've taken a lot longer. People are being more cautious. On the buy side, we're looking very carefully at current trading to make sure that we really understand the trajectory. And I think sellers themselves want to make sure they really understand the partner they're working with. They recognize that these are deals that are going to take 3, 4, 5 years. And it's as much about that kind of emotional connection and that relationship and really understanding that partner as it is about, as you said, about just the headline price.
Okay.
And yeah, no, I'd say if we move it up one level and look at our global primary funds portfolio, then we've certainly seen a slowdown in activity levels. And that really started in the second half of 2022. The first half of 22 was very strong and broadly in line actually with 21, which was a record year by all accounts. That resulted in, I would say, what the type of distributions we would expect in a normal year were in 22, we were off that by about 25%. So they were down roughly 25%. And looking at the first half of 23, it's a similar trend. So I think, we're slightly behind that number, even more so. So it really depends on what happens in the second half. But then again, 21 was a record year. We had twice the amount of distributions back that we would normally expect. So I think quite a lot of exits were brought forward maybe 1 or 2 years from their original plan. And that sort of left also a bit of a younger, less mature portfolio with GPs, and which will take a little bit take a bit longer to develop, so to speak. So yeah, activity down, but it's not completely dead.
Yeah, okay. And Stephen, is that chiming with what you're seeing?
Yeah, we obviously have a slightly different perspective because we're sort of, financing private equity managers and investors. And I suppose at you're absolutely right. It's not as if we're at zero. It's perhaps a bit more concentrated on certain sectors and certain geographies, et cetera. But as a more general rule, there is an acceptance that you're going to hold your portfolios for longer. If you think about last year when platform investments, so kind of new deal volumes were down, 65% of M&A was bolt-ons. So if managers are going to have to hold assets for longer, they want to continue to invest in them. And that was particularly the case in 21 going into 22, where a lot of that capital got invested very, very quickly. And therefore, you were financing your bolt-ons. That then probably pivoted a little bit, not exclusively, but a bit, to creating liquidity. So managers that would otherwise be on the sort of, asset realization phase are now trying to create a liquidity alternative, mainly because the usual source of that liquidity has contracted, quite a bit, and it leads on to fundraising. And that liquidity squeeze kind of affects all participants in the market eventually. So we have definitely seen some pivots in terms of how people finance, and part of it, as Rebecca says, is that the sources that you might have gone to are not there. The high yield, the broadly syndicated loan market is, it's not dead, but it's not open. So you have to find alternatives, and this is a competitive market. Fundraising is competition for capital, and you have to, find as many tools, if you like, at your disposal to really set yourself ahead. And that's kind of what we're seeing, is people looking at different financing means, just given partly in the environment that we're in.
So if we can elaborate a bit on that, then liquidity is clearly difficult to find in certain situations. So what are you seeing? NAV facilities, GP-led transactions, or what are the sorts of solutions you're looking at?
Yeah, look, the GP-led, the continuation fund, which has got a lot of, press, particularly about the last 3 to 5 years, roughly. That is systematic generally of private equity. Private equity a long time ago, and a lot of people will remember this. You used to sell your winners early, get some scores on the door. We all remember that. And then the sort of the focus changed a little bit and said, look, actually, if I've got some of the portfolio that's not going to grow as quickly, is that where I want to divert my resources and my team and my operating partners that Petri talked about? And you now see that managers are holding these winners for longer, and part of that is the continuation vehicle. Part of it is, again, your portfolio is going to be held for longer. It's around about 5.5, 6 years. Matthias made the point. It's not a number that we haven't ever seen before. It's just not the number we didn't see in 2020 and 2021. So we are reverting to some normals in some sense. But certainly that holding assets for longer, how you deal with that, creating some interim liquidity, creating more capital to invest, that remains kind of the use cases. But it does pivot.
Okay. Thea, what are you seeing, or what's your view on the GP-led side? Maybe?
Yeah, so I guess, like everyone else in this room, we're all about, delivering value for our investors. And I don't want to get in trouble with Steve here, but I thought maybe I'd kind of look at things from a slightly different perspective. So when I look at any solutions like a continuation vehicle or a GP-led restructure, I always like to put myself first in the shoes of the LP. And if I was an LP, there's 2 really important questions that I would want to understand. So first of all, why you're really doing this? Is your main driver here really to maximize value for investors because you've got an asset, like Steve was explaining, that needs more time or needs more capital than your current fund can provide? Or are you doing it to improve your DPI ahead of your next fundraise, or to reset your economics? And the other thing, it's pricing and conflicts of interest, which is a really tricky area to navigate as well, because if you are an LP that doesn't have the means to roll over into the new vehicle, am I being effectively forced into taking a really big discount? So I think these are all really important questions. I think they're super helpful tools, and in most cases they're being used in the right way, but every now and then you could run the risk of having a lot of angry LPs on the other side of the phone. So yeah, that's my slightly controversial perspective.
No, I think it was well covered.
We can come in with the sort of the case study again. We've just done one earlier this year for an asset called IU Group, which is effectively it's a digital university. And you're totally right. A lot of the discussion was around alignment. Now, how do we make sure we've got multiple stakeholders?
And it's a really
very
tricky
complicated
exercise to do, isn't it?
But where you've got assets, and I think as we were talking about earlier, it's where you've got an asset that frankly you don't want to sell and your investors don't want you to get rid of. There is a very neat solution where you've got a lot of capital behind these structures now, and people like Matthias have raised huge vehicles. I think showing the flexibility and creativity of our industry, recognizing that where you do get an asset that does have a very attractive growth path, the management didn't want us to exit, but we recognized we needed a new ownership structure. And you could get alignment by having a price-setting mechanism. You've got third parties setting the price. You've got a very deep pool of very credible investors who are coming into the syndicate. But it's a complex process. And I think for the right assets, it can be a very good solution. As you say, the wrong assets, it can have the wrong alignment. And I think a number have happened. And what we'll have to see in future years, particularly if some of the first ones get to their sort of 5-6 year anniversary, is what's that next stage of ownership for them. But at the moment, I think looking across the market, it can be a very attractive exit route, both for the private equity fund, but also recognizing the depth of different types of capital wanting a different profile of investment.
Okay. So Matthias, what's the LP view on these sorts of vehicles then?
I think Lucia covered the LP view pretty well here, so I don't have much to add to it. But I think the alignment and the quality of the asset, the buyer universe here, they're sophisticated. They will not buy just anything. So it is an additional tool to drive liquidity in a otherwise maybe slower market. It had been a feature. We've seen an uptick in activity level in our portfolio with GPs running these processes, but it tends to be for the best assets oftentimes where there is a long runway to go. And the private equity model is maybe not perfect. You have 5 years to find assets, you have another 5 years to develop them, then you have to sell them. You could maybe ride that for 20, 30, 40 years. So maybe there is something to do there on the structure as well of our industry.
Okay. And so on exits, generally then the sort of traditional exits, I think we're seeing some green shoots and maybe the capital markets, but it's still, I think, a tough environment to exit. Stephen, I don't know if you've got on that, and I can turn to the other panelists.
Yeah, I think the exit market generally is difficult. Maybe green shoots, maybe. The one private equity manager recently said to me, says, "Well, buyer and sellers are still apart, but at least we're on the same planet." So we're maybe getting closer. Will it snap back very quickly? I think I think people will still be very discerning, clearly on value, on perhaps preference to some of the sectors that we've seen continued activity. The lower mid-market is certainly easier to finance than the really big deals, which Rebecca alluded to earlier, because it's it just needs different quantums and different providers for it. So yes, is there green shoots? Maybe. I wouldn't suggest there's any kind of rebound today or tomorrow. But again, I think it's about managers finding alternative ways to finance exits, to finance bolt-on acquisitions, to create liquidity, etc. I think again that's one of the themes, right. Certainly for the last 3 to 4 years, perhaps longer, and also their own businesses, their own management company businesses that are looking to grow, make new investments, etc. Where that liquidity would have come from the exit environment, that's slowed up as well. So again, it's that sort of circular kind of argument. So again, it's just about finding different capital and liquidity sources, which is just now firmly on the agenda of private equity managers.
I think there's still a mismatch as well between buyers and sellers, that buyers are expecting some kind of discount reflecting the cost of capital and the risk environment, and sellers are saying, well, I've got a great asset, why would I take a discount now? So that will take, I think, more stability before that unwinds. And I think when we heard earlier from Mark Gregory about the economic outlook, it's not great, but there seems to be a lot more stability. And I think that will help the market into next year as people begin to bridge that gap. And certainly you wouldn't be doing a massive amount of preparation at the moment for an asset if you didn't have a very clear conviction, because you know that the buyer universe is going to be very discriminating and scrutinizing carefully, looking at your business plan. But as you say, companies need to grow, they need to scale. There's many different reasons for exits. I think what you're not doing is having a quick exit and finally you get a very aggressive approach from someone that wants to move very decisively that you saw a couple of years ago. People would approach fully underwritten and move very quickly. Those kind of transactions are happening less and less. But we get constant approaches about the portfolio. People want to take their time to get to know the management, to really understand the business model, because they see there's a possibility of a transaction coming up in the next 12 to 18 months. And generally, I think that kind of origination where buyers are looking across people's portfolio and trying to build those relationships, that puts them in a much stronger position as and when you feel you are ready for an exit.
Okay, thank you. I'm conscious we've got a couple of questions. So does Matthias see fundraising for GPs becoming easier after 2023?
Interesting, it will certainly be, yes. But easier, I think it'll continue to take longer. I think we'll continue to have some sort of a slightly more challenging environment than what GPs have gotten used to over the past 4 or 5 years. So plan for a longer fundraising, make sure you have your existing LPs lined up, and make sure you differentiate and stand out from the crowd. I think returns isn't enough. Most of the returns have been good in the past decade. So what your strategy is and what you're focused on and how that's different from everyone else in the market will be key. On the positive, a lot of funds have already raised, so there are fewer groups in the market, at least if we look at our calendar for next year.
Okay. And Stephen, have you seen NAVs in portfolios fall this year?
If we take NAV measured by loan to value, that has stayed relatively stable for the first 3 quarters. What you will find is individual constituent parts have changed, where one business or a small number of businesses are facing more headwinds. There's tailwinds or something else, so that you get if you like, it sort of balances out to a sort of steady state number. That goes a little bit to valuations as well, where I do think you see managers adjusting for the headwinds and also adjusting for the tailwinds, but at an overall level, relatively stable.
Okay.
Valuations across our portfolio in Q1 and Q2 were up marginally, sort of a couple of percent.
Okay. So I'm conscious we're out of time, but I wanted to give each panelist our opportunity to give us a one-line outlook for 2024. So I'll start with you, Luthia.
I think there will be a softening but ongoing headwinds, which we definitely see as an opportunity for this industry to help even more UK businesses.
Okay.
Yeah, I think it's the metrics have settled. It's not easy, but at least there's stability, and that creates opportunity, albeit I think with a number of elections happening next year, who knows what volatility that could create.
I think it was, as was said earlier today, periods that follow a more challenging economic time have tended to be very good vintage years. So I think this is a good time to invest. And as a primary investor, one of the most important factors is consistency. So don't stop investing would be my advice.
Yeah, I just, again, anecdotally speaking to managers, I think there's a greater degree of pragmatism and realism coming out, where, it's a case of, am I going to hold the whole portfolio for longer, or am I really going to focus on a smaller number? So, I think you might see that start to, like I say, it won't be today or tomorrow, it won't snap back quickly, but I think you'll start to see that exit liquidity environment slowly improve, notwithstanding, any sort of headwinds that we don't know about today.
Okay, thank you very much to the panel and to you for listening.